30 days since Liberation Day, and what a month it's been. Since April 2nd, when the highest tariffs in a century were announced, markets have experienced extraordinary volatility across almost all asset classes. 1 month later, what information can be gathered from these moves? So this is the S&P 500. It's probably a good place to start. We can see that the S&P 500 is right back to where it was before these tariffs were announced. In fact, it's marginally higher than the level that it was trading at heading into that press conference where Trump unveiled the extraordinary boards with the high tariff rates. I do have to say that on a short-term time frame, this rally from the low here does not look super strong. It looks kind of overextended, looks kind of like a rising wedge. So in general, it probably has it might come back and test this 5780. But in general, this probably has needs to have a pullback. Whether or not it retests the low is a different question, and we'll get into that now. So the last time the S&P 500 had a real prolonged bear market was 2022. And here's 2022. We can see that the S&P 500 at the low here was down 28% from its high here. So from this high to there, 28%. This is a bear market, and we also, during this period of time, had 2 consecutive quarters of negative GDP. Typically, that is the definition of a recession, but the NBER did not declare one. But this was really the last time we had prolonged weakness, a persistent bear market was 2022. And someone pointed out that if you look if you take this as an analog and you take a bars pattern where you basically just replicate that price action and overlay it onto our current price action, it lines up strikingly close. And whether or not these things really play out, I tend to not put a ton of significance in bars patterns or analogs or anything like that. But the degree to which it is lined up with from this all-time high towards where we are now it is pretty striking. So maybe we come back and test this high here at 5780, similar to the way it did kind of heading into 2022 bear market before inevitably it sold off pretty sharply. If this does repeat, the S&P 500 would fall to about 3,900. It's important to note a lot of the consensus appears to be that if we do enter a recession, the fair value on the S&P 500 is 4,000. This particular analog would take it down to slightly below 4,000. Remember, markets always overshoot to the downside, and then they overshoot to the upside. It's also important to remember what was driving the S&P 500 in 23 and 24. It was 7% of GDP deficit, fiscal deficit. It was basically insane money printing, kind of stimulus and deficit spending, and it was not tethered to reality. So the stock market in 23 and 24 was kind of getting just utterly insane when it came to fair valuation, fundamental valuation, whether it's the PE ratio, which is price to earnings, whether it's Dow to gold, whether it's the CAPE ratio, whether it's U.S. equity market cap versus, as a share of global equity market cap. All of there's like a dozen different metrics, and they were all near historic levels. So the valuation was clearly getting a little kind of stretched, to say the least. And the S&P 500, this needed to happen. The pullback that we got, this 10% pullback. But on a long-term time frame, remember that the S&P 500, is in a parabolic uptrend. Now, if this particular, kind of analog repeats, if we do get a recession and we get something like this in the S&P 500, it would break that parabolic uptrend. And the other thing to note, we went over this in the hyper-financialization videos, but the U.S. economy is so hyper-financialized that if we get a prolonged period of equity market weakness, this has numerous real-world effects in the real economy. Number one, consumer spending. So the wealth effect describes this effect where people log into their brokerage, they see a big green number because stock market's up, and they feel rich and they go out and spend more. This is called the wealth effect. Well, this also works in reverse. If people log into the brokerage, see a red number, they might not spend as much. Remember, 70% of GDP in America is consumer spending. The other thing is that it drives capital gains tax. The capital gains tax drives overall government revenue. So when you get these prolonged bear markets like we did in 2022 here, this has a negative effect on the deficit. We know that the 2025 deficit is higher than it was this time in 2024. So a number of things to keep an eye on. I would also say the other thing that really matters here is the S&P 500 over gold. A number of people have commented and noted this particular chart, and we can see that there is a huge disconnect between the S&P 500 in nominal terms, which is this white line, and then the S&P 500 denominated in gold. This basically is one way to adjust for inflation, adjust for currency debasement, and look at the real purchasing power gains of the S&P 500. You can see that's a radically different picture when you denominate it in gold. It has essentially been range bound since the mid 2010s. It's up marginally from that kind of post '08 low, but in general, this chart, it looks pretty weak. It had been trading in this range here, but it broke below that range. And you could argue it had a bit of an uptrend, but it broke below that uptrend. And it's relatively been flat going back to the mid 2010s, relatively speaking. Now in white, we see the nominal S&P return. But remember, it's always important to go a layer deeper than just kind of these headline numbers because it's not painting the real story. Again, I keep going back and I'll keep repeating the last time we saw populism was here in the mid 60s into the 70s. This was the last time the US economy saw populism. Populism is horrible for financial assets. Now in white, we can see the S&P 500 was basically range bound here from call it 65 all the way through to kind of the late 70s. It's basically extremely volatile, but just range bound in nominal terms. But when you look in real terms, divided by gold, it denominated in gold, we can see that sure it was range bound here from the kind of the mid 60s into the late 60s, but then with the Nixon shock, when Nixon untethered the U.S. dollar from any real value, gold, removed the gold stand, close the gold window, we can see the S&P 500 in real purchasing power terms fell precipitously, even though in white. It appeared like it was doing okay in real purchasing power terms. The S&P 500 fell back to levels in the late 40s. So if you were in the late 40s, after World War II, if you invested in the S&P 500 in real purchasing power terms by 1980, you had lost money. I think this is really important for people to grasp. This is most likely what we're heading into, and whatever this Nixon shock is going to be, it'll be related to the fiscal. It'll be related to the debt. We need to devalue the debt in real terms, real purchasing power terms. And whether that's a Mar-a-Lago Accord where basically all fiats are devalued against gold and Bitcoin, whether that's the exact way that it looks, I'm not sure, but I am fairly confident that we are going to see, at the very least, this sort of, very choppy sort of performance in real terms. In nominal terms, again, it depends on kind of the fiscal. And this goes to that fiscal dominance framework that people like Lynn Alden have been talking about. I think the one thing that can be said for certain is that the direction of travel is towards reducing government spending. Government spending had gotten so kind of out of control, so insane, 7% of GDP, over $2 trillion deficits. This has gotten so kind of out of control that I don't think we're headed back there in the near term, at least under this administration. Now we know this administration currently in 2025, the deficit is higher than it was in 2024 at the same time. So I fully concede that point. But I think the point I'm trying to make is that in general, the direction of travel, right, with Doge and this kind of 150 billion of cuts, the direction of travel is more towards reducing government spending. Now, remember that from a liquidity standpoint, a currency debasement standpoint, a lot of returns in financial markets are just driven by the denominator, which in this case is the dollar, falling in value. Um, Once you start to adjust for debasement, once you start to adjust for currency issues, devaluations, the returns look a lot different, as we can see in red here. This is kind of the real S&P 500 return. And I think that with this particular kind of direction of less government spending, I mean, we know also that this was a drag on GDP. GDP was the part of the reason that it showed a 0.3% contraction this last quarter was due to government spending cuts, due to reductions in government spending. Remember, federal government spending is over 20% of GDP. It's kind of insane, but this is how it's calculated. So until we fix, the components of GDP, the fact that money printing and government spending, profligate spending is counted in GDP is insane, but it is. And until we fix that, it's important to note that, with that direction of less fiscal, in general, on the margins, that's a headwind to the nominal returns of things like the S&P 500. You start to look at the tariffs, right? Like the entire rally that we've had recently is all kind of on a hope and a prayer. Um, the fact that it's right back to the same level, like there's no trade deals, not a single trade deal. This is all on a hope and a prayer that there will be trade deals. And even if there are, the tariff rate is going to be significantly higher than it has been for many, many decades. This will be another headwind to kind of global growth and things like the nominal S&P 500. There's a number of headwinds in a nominal sense, in my opinion, that the S&P 500 faces. And I think that the real kind of way to look at the S&P 500 is by denominating it in gold. And this is really what's telling the story, in my opinion. So next we'll look at gold, which I think is also telling a very important story. So here in white, we see gold. And this chart goes back to 2020. I'll zoom out even further. This is one of the strongest looking charts I think I've ever seen. Healthy, strong, just I mean, this chart just blows me away every time I look at it. And we can see that it's had this huge run up over the past 2 years. Now, another way to remember or think about this is that the dollar has been devalued by over 50% just in the trailing 12 months. You could think of this as the real purchasing power of the dollar, the inverted gold price. And so, if you hold gold, this might look really great, but what it's indicating is not so great. It is pricing in a significant devaluation in the real purchasing power of the dollar. And this is sending a warning of the fiscal for not just America, but the rest of the world. And so since Liberation Day, we'll see April 2nd was right there. It is up since Liberation Day, although I do expect that it pulls back to at least that level, if not lower. It might even break this parabola. It's up 3.5% since Liberation Day. I think that in the short term, gold faces weakness on this kind of optimism of trade deals and kind of the recent optimism in various risk markets. I think it's misplaced, but yeah, gold will probably see some short-term weakness. It might come back to like 3,000 or something like that. But long-term, I remain bullish. I've been bullish on gold since 2022, 2023, when it was in this kind of 1,800 range. And it's proven to be pretty good trade. Remember, though, what this is actually indicating. So I think when you look at the gold price, think about the gold price, it's important to remember the warning signal that it's sending, which is purchasing power of the dollar. Next, we'll look at the dollar, the DXY, and we can see that it's been in this range for a couple of years now. with 100 as very strong support. We can see that it has had broken that 100 support and is now kind of coming back up to retest it. Whether or not it breaks back through 100 and gets back to like 101, I'm not too sure. I think that in general, this is headed lower because, as I've been saying for a year, this administration needs a weaker dollar. The dollar is grossly overvalued on a balance of payments interest rate differential basis. On a fundamental basis, the dollar is overvalued, and it makes U.S. exports increasingly uncompetitive. You need the dollar to be fairly valued in order to bring high-paying manufacturing jobs back to America. And the and the dollar is still overvalued even after the sell-off. The dollar is still overvalued. Now, with the dollar, it's important to point out some assets like the S&P 500 are right back to where they were. The dollar is not. The dollar is down by 3% since the announcement of the tariffs on Liberation Day. This, in a month for the global reserve currency is a pretty significant move. 3% in the global reserve currency in just a month. It's something to pay attention to. The dollar is significantly weaker. I think that this trend will continue over time, over the next year, year and a half, 2 years. The administration needs a weaker dollar. If you are going to evaluate this administration and how successful they are at their agenda of kind of, you know, uh, uh, real benefits for the bottom 90%, and this kind of populist message, the dollar is, in my opinion, one of the key metrics to look at. They talk about oil all the time, which is important for sure. But I think the dollar really is going to indicate whether or not they are successful at their agenda of bringing back high paying manufacturing jobs. Again, this is going to take many years. But a weak dollar is very bad for the top 1%. It is very bad for the hyper financialized sectors of the American economy. It starts to break this kind of dollar carry trade, this dollar flywheel effect that we just talked about in the past two videos. A weak dollar actually benefits the bottom 90%. Now, import costs go up. That cheap plastic stuff you buy on Alibaba will be more expensive for sure. But in the overall sense, it is offset by real wage gains due to the fact that it is finally cost effective and competitive to make things in America again. Those high paying manufacturing jobs, again, we are not talking about apparel and, a sweatshop making shoes in Missouri. We're talking about high paying, high value add jobs, and the jobs that support those high value add industries as well. A lot of people have mentioned robotics and all this kind of thing, which for sure, technological advancements will always kind of have a deflationary impact on societies, and this will only accelerate with AI and robotics. 100%. In the meantime, I see it more from a national security point of view, which is we rely on our enemies for essential goods, whether it's over 60% of antibiotics, electronics, which go into basically everything nowadays, right? You go down the list, we rely on our enemies for critical components. If we were to have to rebuild our energy grid, estimates are that it would take over 8 years to be able to manufacture the transformers that would be needed, say, following an EMP or a solar flare. So, you go down the list and it is a glaring national security crisis that we have allowed our country to become so reliant on our enemies. And the other thing that is a national security crisis is by running this huge trade deficit, we have accumulated a negative 80% of GDP net international investment position, meaning the rest of the world owns us, whether it's US equities, corporate bonds, US treasuries, farmland, real estate, right? They own us. Negative 80% of GDP. I've never, from what I've gathered, this is the highest any country ever in global history. This is another side of the kind of the national security side of running these persistent, ever increasing trade deficits as a means to get dollar liquidity to the rest of the world, to keep the dollar overvalued, and thereby hollowing out our country more and more. Um, I think that general concept that I just went through, I think that general framework is starting to break. I think that this administration understands Triffin's dilemma. They understand Dutch disease. They've written entire papers about it. They've given speeches recently about these things. I've been screaming about it for a year and a half, and they clearly understand the same concepts. So someone might be listening to those screams. But I think again, the dollar, a weak dollar might sound bad to normal everyday blue collar Americans, but remember the context. This is sure import costs go up, but this is offset by higher real wages. The real purchasing power terms of wages goes up as high value add manufacturing jobs come back. Remember in the videos we just did, the average hourly wage in real purchasing power terms, the correlation to the share of manufacturing in the American labor force, it essentially looks like the same line. High paying, high value add manufacturing jobs can finally come back to America under a fairly valued dollar. I'm not talking about a dollar that is too weak. I'm talking about a dollar that is fairly valued. And so again, if there's one metric to evaluate objectively how successful this particular administration is, it is the dollar. I've said forever, tariffs alone will not fix this. You need a weaker dollar. And so far, they have gotten it. 3% just since Liberation Day. If you go since inauguration, the Dixie was almost at 110 and it's now down to 100. So again, the dollar I think is critical to watch. Let's look at oil. Oil is also extremely important. The signal that it is sending, in my opinion, is extremely important. Oil is down sharply. It's down 17% since Liberation Day. So since Liberation Day, oil is down 17%. This is not what you see when markets are worried about inflation. This is what you see when markets are worried about deflation. At the very least, significant disinflation. Oil 17% in oil in just a month. I mean, this is an incredible move. And you have to pay attention to a move like this. This is not pricing in inflation. This is pricing in lower aggregate growth and therefore lower nominal growth, lower inflation. And so I think, when it comes to a lot of these narratives, it's important to look at the actual data. What is the actual data? What are the markets actually saying? And a lot of times it's counter to the mainstream narrative. So here's the 2-year yield. And here I marked April 2nd here. This candle close was heading into Liberation Day. We can see that the 2-year is basically right exactly after all this volatility, where initially the yield went sharply lower, then went sharply higher. Then we kind of got this bull steepener, and now we're kind of into like a bear flattening. It's basically right back to where it was. Remember, the 2-year tracks the federal funds rate. This is really what the 2-year yield is when you look at the yield curve. The 2-year is mainly a story about the short-term overnight federal funds rate. And I marked that in red here. It's a little off. 430. This red line is where the federal funds rate currently is. So the 2-year had been pricing in about 2 Fed 25 basis point cuts by the Fed, and is starting to unprice those out. Now, if the bond market was worried about inflation, do you think that the Fed would be cutting rates? No, clearly not. The Fed would be keeping rates at 433, if not raising rates. And so this means that, if the bond market was worried about inflation, it would not be pricing in 2 Federal Reserve rate cuts. It is currently pricing in about 2 Federal Reserve rate cuts. You do not get that in an inflationary regime. So again, what is the market actually telling us? Now let's look at the 10-year. Here we see the 10-year. I'll go on the daily. The 10-year is higher since Liberation Day. So this green line was leading into Liberation Day. And we can see, I thought this was interesting. Clearly the 10-year yield also sold off sharply. Bonds were bid after Liberation Day. But then we had this balance of payments crisis start to emerge. Yields skyrocketed higher, 60 basis points in a week. And then we kind of got this general kind of bull steepener. And the thing that I think is really interesting is that as the curve was in this bull steepening, um, the 10-year yield came down. It tested the exact level that was that the 10-year yield was trading at heading into Liberation Day. It tested that exact level, like basically twice, and is now headed higher. So someone who believes in inflation, someone who is in the inflation camp, could see this and go, well, the 10-year is what is that? 19, 18 basis points higher than it was heading into Liberation Day. See the inflation. Okay, so what I would say is you have to look at the components of what go into the 10-year yield. Here we see the 10-year break even rate. Again, there are hundreds of billions of dollars and entire careers on the line with these particular bets, whether it's the bond market or derivatives like these inflation break evens. And here I'll mark. This is what the 10-year break even is a market instrument, forward-looking instrument to track inflation or to estimate, to price in inflation. And heading into Liberation Day, it was pricing in 2.3% annualized inflation. We can see that the 10-year break even is lower than it was heading into Liberation Day. I've been pointing this out for weeks. I will continue to point it out and watch it. But this is not what you would see in a highly inflationary regime. So the 10-year yield being higher than it was heading into Liberation Day, right here, this is not due to inflation. This is due to term premia. This is due to what the bond market is, the premium that the bond market is demanding to hold longer duration bonds. And the reason for this is more of a fiscal concern over the debt, financial repression, those kinds of things. The bond market is requiring a higher real rate to hold this bond, to hold long duration bonds. So here is the 10 minus the 2. The curve continues to steepen. Overall, we've had the curve has kind of had like a weird bear steepener mixed with the 2-year yield actually lower. Like I'm not really sure if there's any signal since Liberation Day in the curve, the shape of the curve, but in general, this trend of the curve steepening, I think will only continue as the bond market, accurately marks to market the fiscal reality of the United States. There's been significant volatility up here, but in general, this trend is of curve steepness. Um, and I think that continues. Here we see the 10-year yield minus that inflation break even that we were looking at. So this tells you what's called the real rate, the real yield. And we can see that following the events of 2020 and all that, the market is demanding a higher premium. This number of 2.038. What that indicates is that in addition to inflation, the bond market is requiring nominal growth. In addition to that, the bond market is requiring 2% extra in terms of compensation to hold 10-year bonds, to hold duration. Um, and so an expansion of this term premium is what has led to the 10-year yield being higher than it was heading into Liberation Day. So here we'll mark Liberation Day, and you can see that. So Liberation Day, the real yield on the 10-year was 180. It is now uh, basically 2. So it's added 20 basis points of term premium since Liberation Day. This is not a story about inflation. This is a story about fiscal concerns and duration risk with holding long-term bonds. So the MOVE index, ironically, interestingly, this is the volatility index for the bond market. This is very interesting, but it's pricing in less volatility in the bond market than we were pricing in heading into Liberation Day. I think that this is probably mispriced. Maybe in the short term, it's fairly priced, but in the long term, this is probably mispriced. But it is a signal. It is something to keep an eye on. Maybe everything calms down in the bond market. Maybe that kind of balance of payments crisis was all we see, and everything is better from here. I'm not super convinced. Let's look at liquidity. This is Fed net liquidity. We can see the TGA run down heading into tax season. This means an injection of liquidity. And we can, and you see that here. We can see that generally it's been range bound. There's no real moves in this Fed net liquidity measure. M2 money supply is actually been headed higher and is about to break the prior all-time high in 2022. Remember, the money supply in a debt-based monetary system that is highly leveraged, the money supply must always expand. Um, Currency must always be debased. This is just the way the structure of the system is, unfortunately. So that's liquidity, break evens. Let's look at spreads. So credit spreads again. If you're worried about the kind of real economy, credit spreads are a good thing to watch. This indicates the risk or the premium that is being demanded to lend to poor quality borrowers, whether that's a a smaller corporation in worse shape, or kind of more high risk borrower. This is not describing the risk for Amazon or any mega cap company that's in great shape. This is more kind of the risk premium of what they call junk or high yield bonds. And we can see, I called a tight here in December of last year in credit spreads. That's proven correct. And I think that, credit spreads had started to blow out following Liberation Day. But, they've given back most of that move higher. Now, in general, though, credit spreads are still, since February, when the S&P was hitting an all-time high, credit spreads are still 100 basis points higher. So that is a notable change just in the past couple months. Now, I think long-term credit spreads probably continue to, in general, move higher. They might pull back toward and retest this Liberation Day level of 344. But I think that the fact that credit spreads are higher than they were heading into Liberation Day paints a picture that risk is elevated, following kind of the highest tariffs being announced in over 100 years. Here we see kind of an approximation of the European yield. This also works for like Canada and Australia and kind of the West, other developed economies. But we can see that their 10-year yield is significantly lower. Remember, our 10-year yield is higher due to an expansion of risk premium, but the European yield is lower, relatively significantly lower, about 18 basis points lower. So this is indicating that what the market is pricing is that this kind of global trade tensions are going to have a disproportionately negative effect for other countries like Europe. This is lower nominal growth since Liberation Day. Remember, the 10-year is actually higher. Now it's relatively flat once once you adjust for the expansion of the risk premium in the 10-year. The 10-year is basically flat. The 10-year is up about 20 basis points since Liberation Day. But remember, term premia expanded by 20 basis points. So once you take the risk premium expansion out, the 10-year is basically flat, which is very similar to what we saw with the 2-year, which is that it is relatively unchanged since Liberation Day. Again, this is not what you see in an inflationary environment. So let's look at VIX. We were talking about the MOVE index being the VIX, or the volatility index for bonds. This is the volatility index for stocks, the VIX. Here we see it on the daily, and we can see that it is right back to where it was heading into Liberation Day. It is ever so slightly higher, but it is essentially right back to where it was heading into Liberation Day, here kind of in the low 20s. Now, I don't think that we are headed back to this regime of short volatility at any and every opportunity. VIX down to like 9 or 10. I don't think we're living in that environment anymore. I think volatility in general will be higher than it has been kind of historically over the recent history. I think volatility will generally be higher. I don't think we're going to see a 9, 10, 11 handle on the VIX again anytime soon. Implied correlations also paint somewhat of a story here, in my opinion. So Liberation Day was here. And we can see that similar to credit spreads, implied correlation, this is the difference between an implied volatility of the individual components, the individual stocks versus the index. We can see that implied correlations have not come back to the level they were heading into Liberation Day. This indicates that there's kind of this embedded risk of volatility across everything. And so the VIX might be back to where it was, but implied correlations are higher, and kind of got stuck at this higher level. Now maybe they come in and they retest, and come all the way back. But the fact that a month later implied correlations are, significantly higher than they were heading into Liberation Day. Meanwhile, the VIX is back to the same level. I think that that's probably pretty notable. Hopefully that was helpful. I'll go over just a couple more that I think are have caught my interest. So this is the Mag 7. Um, and we can see that it's been in a bear market. And I think that a lot of the things that worked, to summarize, a lot of the things that worked for the past 2, 3 decades will not be working as well. We talked about the S&P 500 in the beginning of the video, but I think that a lot of these things will not work as well. And we can see the Mag 7 has been not performing very well going back to December. I mean, I called a top in the S&P December 14th, which was right here. So I called a top here in the S&P 500. And the Mag 7 peaked. The S&P 500 actually started to kind of outperform here, in January, February. But the Mag 7 set this peak, 2 days after I called the top. And then it never got back to that level, even as the S&P was kind of pushing higher in January and February. Mag 7 did not. Mag 7 started to underperform going back many months, way before the tariffs. Um, this momentum trade, this dollar flywheel, this dollar carry trade, all this kind of thing. I think that it is not going to work as well as it has, in the past 2 or 3 decades. Also, want to touch on Bitcoin. Bitcoin and gold. Bitcoin has been trading like a high beta Nasdaq for a long time, but I think that it's going to eventually break that in the medium term, short to medium term. I think it'll break that Nasdaq correlation. I think it'll behave much more like gold. I mean, we can see that going back to 2023, this is a very strong looking chart. Um, I do believe here we'll look at the Bitcoin Nasdaq cross. This is a gold Bitcoin Nasdaq cross, and we can see that Bitcoin has actually been outperforming the Nasdaq in the recent. This goes back like a couple weeks to late February, early March, was the low in Bitcoin over Nasdaq, and this is just pushed higher and outperformed versus Nasdaq. Now it's underperformed versus gold. This shows that going back to December of last year, Bitcoin has been underperforming gold. I've always said I think this is more of an idiosyncratic story with gold strength rather than Bitcoin weakness. But I think that this low of 25 was the low for Bitcoin over gold. I think eventually this pushes higher to retest the all-time high of 40 ounces per Bitcoin, and ultimately, eventually heads higher, and breaks that correlation with the Nasdaq. But in general, even the Bitcoin over gold chart, it certainly looks a lot weaker than the Bitcoin over Nasdaq. But it's still a relatively strong, healthy looking chart. And so I think that, again, denominating some of these assets really starts to paint a much more accurate picture rather than just looking at the nominal headline number. I did also want to touch on the yen. Um, I had called, a long in the yen at 155, and that has proven, to be a good call. Remember, this is dollar yen, so as this line is going down, dollar is weakening, yen is strengthening. I think that the fair value for the yen is like 110, 120. So I think that this still has room to go. If you look at it on a long-term time frame, once it breaks 140, it will head lower to 120. And I think that eventually it will. And the Swiss franc is another one we've been watching. So this is dollar Swiss franc, and we can see that I'll go to a long-term time frame. It has the dollar, remember the numerator, going back to 2002, the dollar has been falling. Is like the Swissy is one of the few currencies where it has actually been outperforming the dollar for 20 years. And I think that there will be this emergence of alternative assets, alternatives to the treasury, alternatives to the dollar are already emerging. This is not a theory. That you look at the IMF data, foreign exchange reserves as a share of total reserves. You look at the total U.S. debt divided by foreign held debt. Right, all of these metrics show that this de-dollarization thing is not a theory. This has already been going on for 10 years or more. And the Swissy is one of the few currencies that has shown it can actually outperform the dollar. Not many currencies can do this, but the Swissy has. And so, this might illustrate it a little bit better to invert it. This is, the Swissy. Um, you know, I don't know. To me, this chart looks pretty strong, and I think that there's probably more strength here, especially if we get some kind of Mar-a-Lago Accord, which again I've been saying for a year is most likely the ultimate conclusion of all this trade stuff, all this tariff stuff. Ultimately, all the developed countries need to devalue the dollar, devalue their fiat currency, for us, the dollar, versus real scarce assets like gold, Bitcoin. And then, certain currency, cross currency exchange rates need to be adjusted. There's no reason that the yuan should be so weak versus the dollar. There are a number of examples. The yen is another one, right? These currencies are not properly, fairly valued. That'll need to be addressed in a Mar-a-Lago Accord. You cannot fix that with tariffs. And it is like trying to put a band-aid on a bullet shot, a bullet wound. And so I think that that's eventually where things head. Is I think that there needs to be an emergence of alternatives to the dollar. This is part of the reason we've talked about this in the hyperfinancialization videos we just did. But this is part of the reason the dollar has become so grossly overvalued, is that it is used by these surplus countries as a store of value, and we need alternatives to that. If we want to break the kind of hyper financialization or the wealth inequality or the second and third order societal effects, like the suicide rate being so, at this level that not seen since the Great Depression, deaths of despair being, doubling over the past decade or two, now higher than the Great Depression. All these different metrics show, political polarization, antidepressant prescriptions, horrible events in public places seemingly every day. All these things indicate that there is something deeply, deeply broken. Wealth inequality is even worse now than it was in the Gilded Age. So we need a weaker dollar, and a fairly valued dollar, and we need alternatives to the dollar. I personally don't see why the Swissy could not be, in part, a new or an alternative store value to the dollar. For 20 years, it's shown it can outperform the dollar. So all these dollar denominated debts that the dollar bulls talk about, those debts got smaller, right? Like the dollar milkshake theory and the dollar bull thesis is that these dollar debts are constantly getting harder and harder to service because the dollar is appreciating. Well, what happens if instead, you take out a dollar debt, but you put those dollars into Swiss francs or into gold, which we know is up 65% versus the dollar? Well, those dollar debts that you just took out are getting smaller. You are not. It's the very opposite of getting squeezed. Those debts are actually getting devalued. So, I think that I think this. If I had to pick one currency to outperform the dollar, I think it would be the continue to be the Swissy. Again, I do think the fair value on the yen is closer to 110, 120 down here. Um, there are other currencies. The euro has shown really incredible strength since Liberation Day. Here is Liberation Day. The euro was trading at 108.3 and it is up to 113. This is a strong move in the euro. I would not pick the euro as an alternative. I would pick much more likely the Swiss franc than the euro. But I think it'll be a basket or a collection or variety of different foreign currencies. And I think gold. Gold is an $18 trillion market. Um, so it is certainly close to large enough. Is not fully large enough yet, but it can get there pretty quickly, to large enough to basically replace the dollar. And I think that having a neutral measuring stick like gold, and eventually I think Bitcoin will be part of this too, uh, will a neutral measuring stick will allow currencies to be fairly valued and will allow for currencies to start to naturally adjust for inevitable imbalances that arise during global trade. They are inevitably going to be imbalances, but the currency, if it's fairly valued, should be the release valve and the equalizing factor. I think that gold and Bitcoin will eventually, gold, has already, and Bitcoin probably over the next couple of years will start to become more of the neutral reserve asset. And by doing this, currencies will start to be valued on a balance of payments basis, interest rate differential basis, fundamentally, which means a weaker dollar. And the dollar started to be valued on a balance of payments basis during that period of time where it was selling off, and yields were shooting higher, and we were basically in an emerging market balance of payments crisis. The dollar was already starting to be kind of priced in this reality of our twin deficit. And it's got a lot further to go, but again, I think the key metric, if out of all these charts, the key one to watch is the dollar, the DXY. And the trade weighted dollar too has pulled back as well. I always point the trade weighted dollar out. Um, this is pulled back, not quite as much. It's still in an uptrend, but this is the trade weighted dollar, and I think that this is technically, more accurate way to see how strong the dollar actually is with the U.S.'s actual trading partners. Right? Why is the euro 40% of the DXY when we don't do 40% of our trade with Europe? So trade weighted dollar again also needs to move lower. Um, but anyways, hopefully that was helpful. Probably missed a couple things, but I think those were the key points. If you have any questions, comments, concerns, feedback, please leave a comment.